Bond funds. Are they a good investment or not? Do they go down in value as the stock market goes down? Or are they a safe haven when everything else isn't? Hey friends, welcome back to the channel. In this video, I'm going to empower you with the 4 steps I use to significantly reduce the risk when choosing bond funds. Specifically, we're going to have a look at how to obtain a fund fact sheet, how to have a look at historical yield as well as credit quality of a bond fund. We're going to have a look at sector allocation as well as historical performance for you to make a better decision. So one thing we need to get clear is that we're actually talking about bond funds and not purchasing direct bonds. So direct bonds are when you go directly to the government or when you go directly to the company when they issue bonds and purchase them directly. Generally, these are a little bit higher in value to be able to get in, such as about 200,000 US dollars to buy one lot. You have to buy it in full. There's minimum quantities. And then you would actually get the benefit of the dividend, but you would have upfront fees and management fees as well. So what we're actually talking about is bond funds, where a fund actually purchases all these collectively, so you don't have to. And each bond fund can be traded like a stock. So you would access these via, say, a banking platform, such as an investment platform or a brokerage. And each of these bond funds would either accumulate in value, where the dividends are reinvested, or distribute, in which case the dividends are distributed to you. So that's the general difference between the two, and we have to get that straight because we're actually talking about bond funds for the rest of this video. So in evaluating bond funds, you can actually get overwhelmed quite easily. It's like trying to decode the title of the bond fund to actually know what it's investing in. So if we have a look at Fidelity's website, we can come down here and see, okay, they have bond funds, equity funds, multi-asset, cash funds, lifestyle funds. If we click on bond funds, and if we scroll down just a little bit, we have, for example, Asia Pacific Strategic Income Fund A, and then the ACC is accumulation, as we said before, and it's in US dollars. And so that's one fund. It has its documents down here. It's a bond fund, so that's the class. It has the price, which is the NAV, the daily change, the 1-year performance, 3-year performance, so just some basic information. But if we come down a little bit further, you'll see, okay, some are hedged Hong Kong dollar funds, some are, once again, accumulation funds, etc. So renminbi funds. So what you really want to do is know that there's different terminology. And what you actually want to do is have a look at and simply Google that fund. So let's say we choose another fund, in this case, Allianz Bernstein, and we want to have a look at the American Income. And basically all you need to find is the fund fact sheet. And if we have a look at the fund fact sheet, which is usually a PDF, it's generally just about 2 pages. And now you have an apples to apples comparison because all these funds are regulated like this. They have to produce a fund fact sheet for the investor. And you have a lot of different detail, which we're actually going to go through in a minute. So it's just 2 pages, but you need to obtain this, and this is step 1. So now that we have the fund fact sheet, we can accurately have a look at the information provided. And the first thing we want to have a look at is the historical dividend and the credit quality. Now, these are basically simple words that mean what am I going to get from the fund in terms of return or dividend, and what's the risk associated with that. You see, companies and governments issue bonds to basically raise money for various projects. But there's a chance of default with these obligations. But in return, you are offered a dividend in return for that risk. So generally, the higher the yield, the higher the risk of default. And what does default mean? Well, it means basically the issuer or the government or company that issues the bond cannot fulfill its obligations financially. And so the whole contract is terminated, so you're at a loss. You run the risk of this bond basically defaulting. And to be able to assess this, you don't really have to do it yourself because there are companies such as S&P, Standard & Poor's, Moody's, and Fitch, different rating companies that actually issue credit ratings for these funds. And so we go from AAA, which is the best, very low chance of default, to D, actually, which is a high chance of default. So how do you actually find the credit quality? Well, if you have a look at the fund fact sheet that we just downloaded, for example, on AllianceBernstein's American Income Portfolio, if we have a look at page 2, we can actually see on the bottom right here that there is the credit quality listed, and you have an assortment of AAA, AA, A, BBB, BBB, CCC, and below, etc. So in this case, its AAA is at about 35%. Correspondingly, if we have a look at the portfolio statistics, yield to worst is 5.83%. So yield to worst actually means the lowest yield you can expect from this fund. And in this case, it's 5.83. So with quite a high AAA rating component at 35%, you can expect about 5.83. In fact, it actually has an average credit quality of BBB+. So let's have a look at another example. So for BlackRock Asian Tiger Bond Fund, A2 US dollars, we can also see that on the second page, the credit rating is listed here. You can see in this case, it has a much larger BBB allotment of 46%. AAA is actually 0, and AA is 3.46. The next highest one is A, which is 22.33. And so its yield to worst is going to be slightly higher at 6.38, because in this case, it doesn't have those AAA ratings in there. It's only got BBB. So these are sort of things you want to have a look at if you wanted to buy a few of these for your portfolio mix. All right, so with this knowledge, you actually want to find or ask for the historical dividends. And to do that, you need to either do a little bit of digging on the web or basically ask your relationship manager. And for example, we've put together some of this data last year, and for AllianceBernstein's American Income Fund, we had the fund fact sheet, so very similar to what you've just seen, various parts of that fund fact sheet, which we'll actually go into more detail in a minute. But also we found the historical dividends. In this case, the dividends are all listed here every month. And here is the annualized yield, or basically this number times 12. And so you get a rough idea of what it is. It's basically, 4.8, 4.9%, 5.3% back in 2020, 4.8 now, etc. So that gives you a good feel of the historical dividends of the fund. All right, so step number 3 is sector allocation. And for that, we want to have a look at a fund's exposure to different countries, what the sectors or industries it is involved in, as well as the top 10 holdings. And so let's dive back into the example. So with our example of AllianceBernstein's American Income Portfolio, we can once again see that on page 2, under country allocation, it is basically 71% United States. So basically this is a US fund predominantly. Has a little bit of exposure in Luxembourg and United Kingdom. I sort of only look at the first 3. The sector allocation is that it is mainly invested in treasuries. In this case, mainly US treasuries, and also high yield type of instruments. It has investment grade corporate bonds and various emerging market hard currencies, etc. So you get a good feel of, okay, well, this is the main one, which is treasuries. So United States treasuries, and you can see down here the top 10 holdings. Well, it's got the US Treasury bonds for 2027 to 2029 at 6.04% holding, and various other treasury bonds and some treasury notes as well. If we have a look at BlackRock Asian Tiger Bond Fund, similar story, where we can see basically the geographical breakdown in this case is China at 35.4%, then Indonesia, then India. The sector is actually financials at about 27%, quasi-sovereign, sovereign real estate. So this is predominantly a financials and China type of fund. And if we have a look at the top 10 holdings, we can basically see that it down here is focused on government, Chinese government, as well as various banks. All right, so step number 4 is, of course, performance. We need to assess the performance because in choosing a very high dividend or a low dividend, these could all be wiped out if the price goes against us when we switch out of the fund. There's a term called parity. Now, parity is applicable to direct bonds. And when you purchase the bond, it basically starts at 100 and then it fluctuates. And then at maturity, it attempts to go back to parity or 100. And during this time, you are given these dividends. The same is not the case for bond funds, because basically bond funds is in a wrapper that purchases different treasuries and different instruments. Those have the parity, but not the bond fund. And what the bond fund actually has is a price. And this price is what we call a net asset value or an NAV. And this actually fluctuates quite significantly. So once again, if we have a look at our American Income Portfolio Fund, all you have to do is have a look at the performance figures. So down here, we have performance and we have basically calendar year performance. And if we have a look at performance first, 1 month, year to date, 1 year, 3 years, 5 years, 10 years, and the life. And for calendar performance, it basically goes into the different years. Now, the different class of funds, you can have one fund manager that has called this fund American Income Growth, but it has different classes, Class A, Class C, Class I, A2, different currencies as well. So that's part of the decoding exercise. But if we have a look at it, actually you can see this thing fluctuates a lot. In 5 years, it's only made 2.44. In terms of its net asset value, appreciated 2.44. And the year to date, currently as of March 2020, it's actually lost 5.49. So that gives you a rough idea. Here's the cumulative of that for the calendar year performance. In 2021, for example, it was basically minus 0.3. For Class A in 2020, it did quite well at 4.59. So if we have a look at another one, which is basically our BlackRock Asian Tiger Bond Fund, A2 class, if we have a look at the cumulative performance, it's only got one class here for this fund fact sheet. Basically, in 6 months, it's lost 11%. Year to date, it is minus 8.21. In 1 year, or the last 1 year, it's lost 13. Last 2 years, it's lost 3. Last 3 years, it's lost 4%, 4.59%. The calendar year, which is January 1st to December 31st, in 2021, it lost 7.41%. In 2020, it gained 6.58. So specifically with this fund, what it's trying to do is it purchases all these different Chinese holdings and Chinese different banks, and they all hand out a dividend. And basically it reinvests it to give you a net asset value appreciation, or in this case, a loss as well. So we need to be very, very careful of this. All of these have a growth of $10,000 as well. This one is the global financial crisis down in 2008. And now we actually have the 2020 financial crisis, which I'll show you right now. So if we further have a look at something that I've put together for some of our clients and friends, we have sort of a bank recommendation versus our recommendations of a basket of dividend funds. So the bank sort of recommended Allianz, All Market Income Portfolio, Global High Yield Portfolio. We sort of went with Fidelity China High Yield, BlackRock Asian Tiger Bond Fund. In this case, it was the A6 Hong Kong dollar hedged one. And then the Allianz Bernstein's American Income Portfolio Fund. So how did that actually work out? Let's have a look. So if we have a look at the 2020, when COVID started, everything lost. The stock market crashed. We had bonds and bond funds that were crashing, and there's no difference here. So if we have a look at the year to date, it was minus 13.5 from January to March, and then in July, it actually bounced back from January to March to 0.21. So basically from that same time frame, it bounced back sort of 13%. And so if we have a look at Fidelity's China High Yield Fund, its annual performance, you can get a gauge of, okay, in 2021, it lost 18, 2020, it gained 8.6, 2019, it gained 12.2, etc. So you want to have a good feel of this kind of fluctuation or the volatility before you make an investment, all right? And if we have a look at BlackRock Asian Tiger Bond Fund, we can also see that during that market crash, it lost 6.4%. But then by January to July, it actually gained back 1.28. So you can argue that it gained from -6 to +1, or basically about 6.5%. And so basically on the 1 year return, it was 13.79. 6 months, it was -11% total return, etc. So you get a good gauge of where things are going and how much these funds are actually fluctuating. And so for AllianceBernstein's American Income portfolio, which we were looking at, this one actually lost 12%. And from July, it then gained back in those few months up to -1%. So a gain of sort of -11%, or a gain of about 11%. And generally with COVID and during that time, the US was harder hit than China. So at that time, the strategy was actually to have a look at China funds versus US exposure. So now if we have a look at the bank recommendations, now at the time the bank was recommending US exposure. So they chose Allianz Income and Growth. So around April 20th, when the stock market crashed, it lost 10%, but actually recovered quite quickly in July to +3%. However, if we have a look at its all market income portfolio, which was another fund that the relationship manager chose, during July for the same year, it was still down at 11%, -11%. So it actually didn't recover that quickly. And same with the global high yield portfolio, another AllianceBernstein fund, mainly US exposure. It also remained low at -8%. So I hope now you have sort of an appreciation that these bond funds that give dividends, either distributing them or accumulating them, can actually fluctuate quite a lot when the stock market moves. They're not bulletproof. And because of this, you're probably better off to allocate to 3 to 4 of these, such that you have a bit of a diversification, not only in country, but also in sector. And you can choose them, you're probably expecting about 3 to 8%, but basically work this out with your financial advisor and come up with a plan that is appropriate to your risk level. So as a recap, these 4 steps of getting the fund fact sheet so that you know how to compare apples to apples, having a look at the historical dividend and the credit quality so that you know what kind of risk you're taking for what kind of yield you're expecting, having an assessment of the sector allocation and possibly diversifying or having a look at market conditions around the world, and if you want to expose there, as well as historical performance of that fund. With these 4 steps, you'll be much more equipped to make a proper decision than if you didn't do them. So I hope this information empowers you to be able to make a good decision when purchasing bond funds. Know that there are risks, know that it goes up and down, but talk to your financial advisor. However, if you are actually less risk adverse, you probably have to purchase these bond funds and equities through an investment portfolio or investment product of some sort. And what better not to get a bank to co-invest with you, such as a premium financing setup, which I talk about a lot in this channel. I'll link that video in the description over here. Thank you very much for watching, and I'll see you in the next one.